Hey, good morning, everyone, and welcome to today's live stream. I'm really happy to be here with you today. I hope you're having a great Wednesday, and it's been a great week for you. Weather's fantastic, a little cool of late, but still, I'm not complaining. The sun is shining, and I hope you're all doing well. Today is actually going to be a really interesting session because it speaks to this idea of how to just sort of approach investing and how to do it from a long-term point of view. So many people will say, well, all you advisors always talk about long-term, think of long-term, so you can ignore these times when markets are on the decline. And that's not the case. It's just not accurate. What we're really talking about is let's say you're in your early 30s or 40s, and you're going to be retiring at, say, 65 and living in retirement 25 or 30 years. That's a long time. And so you need to be thinking about how to structure your investments, your portfolios in a long-term way. There are obviously times where you need to think about near term, but today we're going to be talking about how to think long-term. Now, if you have any questions, please put your comments below in the live stream, because I want to hear what you have to say, what your thoughts are. Share this with anybody you think that should see this. Our live stream is simulcasting across Facebook and YouTube. So if you are watching this in the replay on LinkedIn, know that you can go over to the YouTube channel and see all the other videos. This will be the 15th video we've done for live stream, so we're getting a pretty decent library on content. And again, please like and share. If you like this video, please like and share it, because it helps the algorithm and it helps more people to see it. So that would be very useful. So let's begin. And again, if you have any questions, just fire them away, and I'll deal with them as they come up. Today, again, we're going to be talking about the principles for successful long-term investing. So let's talk about the first idea. So really, you have to be thinking the fact that you're probably going to be living a long time in retirement. And this is a chart on the left-hand side. Shows if you're 65 years of age today, what are the odds, the percentages that you're going to be living to the age of 80? So then something here that's kind of really interesting, and that is the case for marriage, and we'll get into that. But if you're 65 today, a man has a 63% chance of living to the age of 80. A woman has a 73% chance of living to the age of 80. And if you are a married couple 65 years of age, your chances of living to age 80 are 90%. So that's a case for marriage. So single people, it appears statistically, single people don't live as long in retirement. And now if you look at this to age 90, so let's push it out even further. If you're 65 today, a single man has a 23% chance of living to age 90, a 34% chance for a woman, and a married couple, 50-50. I love it. So if you are thinking about, why should we get married? What's the point in getting married? Marriages, half the marriages end in divorce. Well, here's a good reason, because you're going to live longer. Now, I don't know if that means you're going to live longer and be miserable. I don't know. I hope you have a great marriage, but it does mean that married couples tend to live to older ages. Now, the second part of that slide really talks about the retirement savings gap. So if you think about this, a survey was, what is the percentage of people that answered they need more than $500,000 in retirement? And, about 70% of those people said they agreed that they need to have at least $500,000 or more dollars to retire. But when you look at the actual savings, so the portfolio, the amount of money that people have saved, you'll see here that 55 to 64 have about $134,000. 65 to 74,000 have about $164,000. And then the over 75 years old has about 83,000. That's the average, okay? So think about the average. That's the affluent down to people who are living off of government benefits. So take it as you will, but what I've learned over the 20 years of doing this, and that is that people are not saving enough for retirement. It's just clearly not happening. There are obviously some cases where you see people and they've got large investment accounts and they've done really well for themselves. And then you see other accounts where people didn't have the value of working with an advisor. And one of the things that we like to say is that, well, it's not we like to say, it's just statistically, the studies have shown that when you work with an advisor, you actually end up with more money. Why is that? Because an advisor is kind of like your coach, right? Trying to encourage you to do better and to save more and to make better choices. And part of that conversation, I'm going to share in another slide, is talking about the behavior of investors when markets are up and markets are down. So an advisor helps you to see through some of the really nasty things that happen in the market. And so I would say to you that if you want to have a little bit more money, actually a lot more money in retirement, you should really take the advice or working with an advisor, and you'll see the big difference. Okay, so the next slide. Cash isn't always king. I'm saying this because, you know, a lot of people through the pandemic went to cash. They put their money in GICs, and that might have been for a short term, just because of the idea of panicking. Short term, it would have looked all right, but the timing of markets, most people never get it right. And so just showing you sort of the history of a GIC over the years from 1960, the 1900s, 2000, so on, you'll notice that GICs, interest rates were much higher, and so GICs did a good return. But right now, you look at the bottom right-hand corner, you'll notice that's the year 2020. GIC rates are really not what you want to be in. Inflation is much higher than what you're going to get in a GIC rate. If you look at the inflation, this has actually been in the news really very recently, the cost of everything going up. Fuel prices, you know, $1.35 at the pump for the lowest grade fuel that you can buy. Home prices in the GTA are at least $1 million or more for a starter home. Education, medical, everything has gone up in value. If you have your money in GICs, it should be for something that you need to pay for near term. So let's say, for instance, if you are going to be putting a down payment on a house in the next 30, 60 days, a GIC is a good place to put your money for that period of time. But if you're thinking about retirement, you need to have equities in your portfolio. When you're going to be pulling money from your portfolio, and it has to weather both negative markets and positive markets, you need equities to grow your portfolio ahead of your withdrawal rate and ahead of inflation. And if you don't have any equities in your portfolio and you're just sitting on GICs, you're going to diminish your account in a large way. Unless your portfolio is in the millions of dollars for retirement, then it's likely that you could have money in GICs if you had a modest lifestyle. But most people need to have some measure of equity component. We'll get into that. Okay, so dividends and compounding. So let's look at the top chart. That light gray line that is on the lowest part of the graph shows if you were just comparing the increase of your portfolio just from a point of view of the underlying security. So if you're in a mutual fund, segregated fund, or you're just in stocks, just think about what is the incremental increase of the value of those stocks or that mutual fund over time without reinvesting the dividends. So just simply, what is the value of those funds, the price only, if you will. You can see that the difference here is when you invest your dividends and allow that to compound over time, it's a massive difference. And why I'm sharing this with you, obviously, if you've been investing for a number of years, then you've had the value and experience of either seeing it yourself or talking with your advisor, and that is reinvesting your dividends. So I wanted to show this as a clear illustration as what is the difference of when you're actually comparing it, just the price of your investments versus investing your dividends. Now, the asset classes versus inflation. So just to give you some sense of why we say you should have some equity in your portfolio during retirement. Obviously, many people have it while they're working, but just look at inflation. That's that light green line, inflation going up over time. That's the cost of everything going up, you having to pay more money for things over time. But then you look at other things like GICs, bonds, and then you get into equities. So the bonds is that sort of teal color, and then that darker line and the orange line above, those are equities, right? So whether they're small cap or large cap doesn't really make any difference right now. But what the point here is that equities obviously are outperforming inflation, outperforming cash, outperforming bonds. And so this is a really good illustration for you to see that you should have some measure of equity in your portfolio over a given time. Now this is it looks like a complicated chart, but it really isn't. What I want to share with you is something that's very difficult for many people because I've been doing this for 20 years, and a lot of people get very, rightly so, get very nervous when markets collapse. When we saw the market collapse in February last year, it was like a straight line down. It kind of reminded people of what happened during the worldwide financial crisis, right? People remember that. It's not that far away, and they're thinking, oh, it's happening again. And so they want to take their money out of the market. But what happened when you saw my last live stream last week, and I showed the S&P TSX, you see that going almost not straight up, and it's jagged a little bit, but it's gone right up and reaching all-time highs. And so what's really important for you to understand is it's very hard to time the market. People think that they can time the market. They're going to get it wrong most of the time, and I have some statistics to share with you what that means. But let's look at this. This is an example of what the markets look like over a period of time, say from February 2020, February 2020 last year to now. Okay, so if you see that that collapse, this is comparing three model portfolios. So you've got the S&P 500, which is that green line. The light blue line is a diversified portfolio of 60% equity and 40% stocks, or 60% equity and 40% fixed income. And then that darker blue line is kind of the reverse, still a diversified portfolio, but 40% equity and 60% stocks. So you would have the light blue line would be somebody that has a higher risk tolerance. They can accept more risks because that's why they have more equity. Whereas the dark blue line is somebody who is a little bit more conservative. They're not really want to have a huge exposure to equities, and so they're going to have a higher fixed income component, so that you can understand the difference. What this is really illustrating is that that green line, that's the market, okay? The market dropped by 50%, but the two diversified portfolios only dropped by about 25%. So the value in having a diversified portfolio, whether it's a more conservative or a little bit higher risk, the idea that you have a blend of both equity and fixed income allows for you to weather any of these massive, sharp declines. And so you can see that, can we all agree that all three portfolios are kind of in the same place? Okay, the market is slightly higher than the diversified portfolios, but they're more or less in the same area. So what this is really speaking to is, how can you put a portfolio together where you can actually go to sleep at night, lower your anxiety? You're really talking about how to build a portfolio that's going to actually grow and meet your return goals while not giving you a heart attack at the same time. And so that's the real issue here, is that the market dropped severely, but the diversified portfolios didn't. And so that's why it's really important for you to think about that. It provides, and also moving from the sharp decline across the page to the right, over time, what's that really showing is that the diversified portfolio provided a smoothing out, if you will, of the market volatility. And that's really helpful for you when you're trying to stay in the game and not pull your money out of the market. It really helps you to actually weather that storm. And the other thing, and the last thing about that slide is, okay, so if you were to say, well, the market actually went up 200% over that period of time. That's true because it went down so dramatically. So the starting point is much lower than the diversified portfolios. And so if you're just looking at it from the increase in the market, the market went up 200%, but the actual balances, so if you think about what is the actual cash in the portfolio at the time, the actual balances in the diversified portfolios are greater because they didn't decline as much. And so there wasn't as much ground to make up. And so that's really important for you to think about when you're putting your portfolio together. Okay, so now the bottom slide talks to a little bit about what happens when the markets decline. Okay, so are you the kind of person when the markets drop dramatically, you were like freaking out and you're really upset? And I'm not making fun of you because this is a real thing. And then you just said, I'm out, I'm gonna get into cash. That goes back to those risk tolerance questions you have when you open an account and the person said, can you answer these questions? And you said, if the market dropped by 5% or 10%, what would you likely do? Take your money out, do nothing at all, add money to your portfolio? And you're like, I don't know. And you check a box, right? Well, this is one of those situations. The market declines, and what do? That orange part on the graph below represents the average investor return, about 2.9%. Let's just call it 3%. That represents not the actual return if the person stayed invested. That is the behavior of most investors, in that they pull their money out of the market and then try to put it back into the market, and they miss the timing, right? So you're pulling the money out at a low point, and then you're trying to put the money back in. But the problem is when you reinvest your money, it's usually you're trying to find the bottom, but you're not quite sure. So the market comes off the bottom and higher than what you sold at before. So now you're losing twice. You're buying in at a higher value. And so what that represents is you have a 3% average rate of return. If you look at the areas where it shows the lines of the 40-60 split, the 60-40 split, and the S&P 500, which is just the market, then you're really looking at, if you stay invested, your long-term rate of return is going to be 6%, 6.4%, 7.5%. So those are the reasons why staying invested long-term is important. And I want to just say something briefly about because people say, well, David, you know what? I'm retiring next year. I can't afford to do that. Well, you've seen in the other slides, I would encourage you to go back to some of the other slides or presentations that I did. And we talked about that retirement window. There's a 5-year period before you retire. So pre-retirement, and then there's the first 5 years of retirement. You do not want to have the same portfolio going in the first 5 years as you, let's say 10 years before retirement. You do not want to have the same asset allocation, the same weighting. You want to trim that down to be less aggressive in the 5 years before you retire, because time is not on your side. So it's not about coming out of the market. It's just being a little bit more conservative because you don't have the time to make up from that. If you think about the financial crisis in 2008, it took about 5 years for people to make up the ground of what they lost. So you think that's really important for someone who is 5 years away from retirement to not be as aggressive. And those first 5 years, while you're retired, you do not want to have negative returns, because that's just going to amplify the amount of money that's going to come out of your portfolio. It's not a good situation. Okay, so volatility is normal. That's nice for me to say volatility is normal, but it is normal. You look at them, just pull up a graph of any index you want, the S&P, the Toronto stock market, the NASDAQ, you're going to see that the market swings from highs to lows easily 50% on the year. And you have to get used to this idea that volatility is going to be around for a long time. So you think about long-term investors really should not overreact to short-term volatility. Over the last 41 years, the market has been up 76% of the time at the end of the year. So think about that. It's in your favor to be invested, to not get out of the market. It's just in your favor. Investing is not a straight line. And look, you can see right now, this is up and down, but you have to consider the fact that if it's in your favor to be invested over the last 41 years, then you got to be thinking you got to stay in the market. History is heavily on the side of those people that have not overreacted to market corrections. In fact, if you look at a diversified portfolio, and we're going to get into that in a second, over the last 15 years, people have gotten about 6.7% in a diversified portfolio, despite all of the issues. And that's really important to consider. Okay, so now I'm going to share with you everything that you could be invested in, and just giving you, it's nice to have an advisor say, oh, you should stay invested, and over the 15 years, you can get almost 7% in your portfolio. And it sounds like it's just advisors trying to feed you information, but look at the statistics. This is what you could have invested in for a long time, okay? 2006 all the way up to 2020. This is everything you could be invested in. Real estate investment trusts, stocks, bonds, cash, GICs. I mean, it's all here in front of you. And why am I showing you this? Because that light gray area is an asset allocation, or we call that diversified portfolio. And if you think about why am I showing you this? Well, you have to think about what is the impact of your portfolio on sort of volatility, right? So that's important. And return, those are the two things. So when you think about when you're investing your money, you say, if I'm going to get 5% on my money, let's just say 5%, okay? And there are people that need 5%, people who are retired and want their money to grow over time, but don't want the risk because they don't have any more money and they need it to last their lifetime. So 5% seems to be, hey, I'll take 5%. That's good. Thank you so much. And then there are people that are saying, no, I'm 35 years old. I don't need 5%. I need 15%. Everybody's situation is different. But what I'm sharing with you here is this. What is the risk to you and the reward? If you're going to put your money at risk and only get 5% return on that, that's not worth it. It's not worthwhile to push all of your money to the line. It's like being at a casino and saying, I'm going to put it all on red and I hope that it lands on red. The reward isn't good enough here, right? So you need to be thinking about what you can put your money in that's going to provide you the most, or the kind of return you're looking for with the least amount of volatility. And that's why we look at a diversified portfolio. It's impossible really to know which asset class is going to be the hottest one year over another. It's a difficult thing to do. And if you look at the diversified portfolio, it's never really been at the top, and it's also never been at the bottom. So if you're thinking about that right now in terms of swings, that's really a good thing to get as a good starting point, is give me an asset class that is never really at the bottom, and it's also never really at the top. It's kind of in the middle. And why we're saying that, because planning, when you're working through financial projections, you're trying to think about retirement and how much money you're going to need in retirement, and those are based off of deposit rates and how much rate of return you're going to have and how much income you're going to need at retirement, your spending rate. To plan, you need to be able to have some sense of consistency in terms of how much your portfolio is growing over time. If you have your portfolio getting like great returns, look at that first box, top left-hand corner. I think it's like 35% for real estate investment trust, and then a negative 35% the next year. How can you plan for that? That's just not helpful. So having the diversified portfolio allows you to plan much better because it has a rate of return that is within a certain range over this, look at this period of time, that is easier to plan with. That's one of the things that I want to draw your attention to right now. The other concern, or it's not so much of a concern, but you think about the last 15 years hasn't been kind to us, right? We've had wars, we've had weather patterns that have been very disruptive to our economies. We've had geopolitical events. We've had financial crises. We've had pandemics. It hasn't been kind to us as investors. It's been actually very difficult to try to invest money. And so if you're putting it into asset classes inside of this environment where we've got these wild events happening, and you got to think that it's going to continue, then you want to be in an asset class that is actually going to be weathering that and sort of cutting through that in a way that minimizes the impacts of those things. And so a diversified portfolio does that. It's important to consider. Okay. Oh, and one last thing, if you look at the right-hand column, this is comparing volatility against your annual return. And so you look at the diversified portfolio, that gray area, you've got, it's really impressive to see that the return on the diversified portfolio over the period is 6.7% and has almost the lowest volatility. So that's really important because you want to get a decent rate of return and you want to be able to sleep at night. And so diversified portfolios are the key here. Okay, staying invested matters. This is just a great slide to talk about timing of the market. You are an investor and you're thinking, you know what, I've got this crystal ball, and professional money managers have a hard time doing this. So I would say to you, it's really important for you to not try to time the market, but let's look at this. If you were investing in the market and you were fully invested in the market, okay, so you didn't take your money out from 2001 until 2020, this is a long period of time, the return in the market was 7.5%, okay? Now, if you missed the 10 best days, cut in half, 3.35%. So you were trying to time the market, you didn't want to be in the market, and there's also this, we're in a period right now where they say sell in May, right? And so people tend to, you'll see professional brokers, and there's always this phrase that says, you might as well just get out of the market. Well, you're going to be missing some of those best days. If you miss 10 best days, you're going to get a 3.35% rate of return. Miss the best 20 days, now it's less than 1%. And I mean, it just gets worse, right? You miss the best 30 days, you're in a negative, and then you add in inflation on top of that, like you're seriously losing money. So statistically, if you just stay invested, you got a 7.5% in the market, right? S&P 500. Whereas if you try to time it, man, oh man, it's super hard. And so these are just giving you some insights about trying to not time the market, better to stay invested. And we just say a blend of both stocks and bonds, so equities and fixed income, has not suffered a negative return over any 5-year rolling period in the last 70 years. That is super important because when you look at this slide here, you got a 1-year, a 5-year, a 10-year, and a 20-year. If you look at the equity, if you look at the portfolios here, sure, in 1 year, you're going to have these crazy times. We saw markets drop dramatically in February of last year, right? Really dramatic negative returns followed by massive positive returns. And so if you're a long-term investor, it makes sense that long-term smooths out the negative returns. This is just simple. It's actually, I don't want to say it's common sense, but it's just the whole point of this live stream today is just to encourage you to stay invested, to communicate with your advisor, to make sure you have a portfolio that's not on one thing, but has some diversity to it so that you can weather the storm. Fixed income, people say, well, I don't want fixed income, the returns are so low. But you know what? in times of real market volatility, fixed income is your best friend. It's the thing that saves your portfolio from dramatic losses. And I would encourage you to talk with me. If you have any questions, send me some questions. I'm happy to talk with you anytime. That's it. This is a pretty quick video and some sensible advice in terms of how to actually structure your portfolios. If you have any questions, please put them in the comments below. If you're watching this in a replay, again, you can still comment and I'll comment on it. Share with anyone that you think needs to see this. And head on over to my YouTube channel where you'll see all the other videos that I've posted on the live stream. I look forward to seeing you in the next live stream on. We're not going to be having it next Wednesday because that's the day before a holiday, and I doubt that anyone is going to want to watch a live stream. I think we're all going to be excited to get out and enjoy our holiday. The following week, we're going to be having on one of the best lawyers in the GTA to talk about divorce. And I think it's going to be an important session because that has been a hot topic of late. Well, anyway, thanks very much for tuning in. Have a wonderful rest of your week, and I will see you in a couple weeks. Everyone take care, and thanks for watching.